Wendy Moran, an assurance partner at McGowen, Hurst, Clark & Smith. There is new revenue recognition accounting guidance that is effective for all non-public companies for years beginning after December 15, 2018. This new guidance requires a 5-step analysis of revenue and additional reporting disclosures. This video discusses Step 2, Identify Performance Obligations. A performance obligation is a promise in a contract with the customer to transfer to the customer either 1, a good or service or a bundle of goods or services that is distinct, or 2, a series of distinct goods or services that are substantially the same and have the same pattern of transfer to the customer. A good or service is distinct if both of the following apply. Number 1, the customer can benefit from the good or service on its own or together with other readily available resources. 2, the promise to transfer the good or service is separately identifiable from other promises in the contract. If not, companies should combine the goods or services with other promised goods or services until they become distinct. Examples of potentially separate performance obligations include granting options to purchase additional goods or services when those options provide a customer with a material right. A material right exists when a customer is granted right in the future that other customers don't have as a result of entering the contract. An example of a material right is a right to renew in the future at a discount that is not offered to other customers who are not entering the contract, or an extended warranty or separately priced warranty. How are warranties and contracts with customers accounted for under the new model? The price of a warranty may be included in the overall purchase price or listed separately as an optional product. The new revenue recognition standard identifies 2 types of warranties. 1, assurance type warranties. These exist where there is a promise to the customer that the delivered product is as specified in the contract. Account for assurance type warranties as a cost accrual, not a separate performance obligation. The cost accrual is done at the time of revenue recognition. 2, service type warranties. These exist where the customer and the company provides a service to the customer in addition to the assurance that the delivered product is as specified in the contract. Account for service type warranties as a performance obligation in the revenue contract. When another party is involved in providing goods or services in the contract to the company's customer, the company must determine whether its performance obligation is to provide the good or service itself, acting as a principal, or to arrange for the other party to provide the good or service, acting as an agent. This decision centers around control, which is the ability to direct and use and obtain substantially all of the remaining benefits from the goods or services. Indicators that the company controls a specified good or service before it is transferred to the customer and is acting as the principal are as follows. The company is primarily responsible for fulfilling the promise to provide the good or service. The company has inventory risk, and the company has discretion in establishing prices. Revenue is then recorded gross of expenses if these indicators are met. If the indicators are not met, the company is considered an agent, and revenue is recognized net of expenses on the financial statements. I hope you found this video helpful as you begin to evaluate the second step in the revenue recognition model. We'll be posting additional videos on revenue recognition soon. In addition, I encourage you to reach out to your accounting professional or us here at McGowen, Hurst, Clark & Smith for additional information and advice.